we now have a new moment in 2025, which is we now have more things becoming synthetic. And so that's why Bitcoin, of course, remains the OG in our view, because you now have a digital store of value. But I think you want to think about the other side of that ledger. What is Wall Street going to do? And in our view, Wall Street is going to play a very significant role in creating a market for digital assets. And in our view, the biggest winner here is Ethereum. So let's think about what it means for Bitcoin's upside. If gold today is at 4,000 per ounce, and maybe it'll get to 5,000 per ounce, well, we want to think about what Bitcoin's Bitcoin to gold ratio is. What percentage of Bitcoin's network value should mirror that of gold? And if it's only at 10%, then you get a $140,000 value for Bitcoin. I think that number is too low. I think it's going to basically match gold's value or even exceed it. And that's how you get to the $1.4 to $2.2 million of value per Bitcoin. So we're still quite bullish on Bitcoin here at around 110,000.
Let's get right into a deep dive from Tom Lee's compelling vision of a monumental macro shift on the horizon. For nearly a decade, we've witnessed the unparalleled ascent of Bitcoin, the original digital asset delivering a staggering 100x return since its $963 valuation, far outstripping even tech giants like Nvidia and traditional safe havens like gold. Ethereum, remarkably, has dwarfed even Bitcoin's performance with a 500x surge. Lee posits that the year 2025 marks a pivot as significant as 1971, when the dollar decoupled from gold, becoming a purely synthetic currency. This pivotal moment forced Wall Street to innovate, creating a vast array of financial instruments, from money market funds to complex derivatives, to cement the dollar's global dominance. This historical context is crucial. As Lee argues, we are on the cusp of a similar blockchain-driven metamorphosis, where Wall Street's ingenuity will once again reshape the financial landscape.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
We've been writing about crypto for about 9 years now. And at that time, Bitcoin was originally $963. And as of September 26th, as you can see, Bitcoin has been the OG asset class, returning over a 100x since then. It's had twice the return of Nvidia, which has been a 65x, and has dramatically outperformed gold, which has roughly tripled in that same 9-year period. And as an aside, Ethereum has outperformed even Bitcoin, delivering a 500x in that period of time. Okay, so let me level set. The reason I think 2025 is the biggest macro shift since the gold standard is I got to take you back to 1971. And in 1971, the dollar went fully synthetic. That was the year that Nixon ended the convertibility of dollars into gold. Now think about that for a moment. In 1971, the dollar no longer represented anything except another dollar or a promise to repay. And when we think about that, most people said, well, gold was the trade in 1971. That's true, but it wasn't really the big opportunity. In 1971, the financial system had to suddenly think of ways to make sure the dollar remained dominant, because if the dollar wasn't convertible into gold, another currency could be dominant. And so what Wall Street did was they created a huge market for the dollar. Money market funds, futures, debit cards, mortgage-backed securities, currency swaps, interest rate swaps, index futures, zero coupon, CDOs, etc. That was the innovation that followed 1971. And in fact, 7 of the top 30 largest companies in the world now are financial institutions. Okay, well, another thing is happening today, which is that Wall Street and AI are building on the blockchain. And in the US, the groundwork was laid with the Genius Act, which set the stage for a stablecoin boom. And then the SEC launched Project Crypto, which is moving Wall Street onto the blockchain. And there, of course, are 2 other pieces of legislation underway in Washington. One is the Clarity Act, and the other is the Bitcoin Strategic Reserve Bill. And what that means is that we now have a new moment in 2025, which is we now have more things becoming synthetic. And so that's why Bitcoin, of course, remains the OG in our view, because you now have a digital store of value. But I think you want to think about the other side of that ledger. What is Wall Street going to do? And in our view, Wall Street is going to play a very significant role in creating a market for digital assets. And in our view, the biggest winner here is Ethereum. So let's think about what it means for Bitcoin's upside. If gold today is at 4,000 per ounce, and maybe it'll get to 5,000 per ounce, well, we want to think about what Bitcoin's Bitcoin to gold ratio is. What percentage of Bitcoin's network value should mirror that of gold? And if it's only at 10%, then you get a $140,000 value for Bitcoin. I think that number is too low. I think it's going to basically match gold's value or even exceed it. And that's how you get to the $1.4 to $2.2 million of value per Bitcoin. So we're still quite bullish on Bitcoin here at around 110,000. But let's think about this other story arc that's going to develop, which is Wall Street is going to innovate on the blockchain over the next 10 to 15 years. Okay? And part of this story arc is, and we've already seen it, is that we're talking about stablecoins, which is tokenized dollars. So that's almost like the 1971 moment. But we're talking about tokenized equities, tokenizing credit, real estate, reputation, and eventually intellectual property. All things that are measured in the economy today. And I think there's going to be invisible measures that get monetized on the blockchain. Data collection, royalty payments, loyalty programs, agentic AI, and even important things like proof of human. So a lot will happen on crypto. And we already know Ethereum has experienced this ChatGPT moment because of stablecoins. Here's just a list of different companies and entities that are building stablecoin projects. And you might wonder, why does the US government care about stablecoins? Well, it's the same reason the US cared about the synthetic dollar staying strong. Today, the US dollar is 27% of GDP, but it's 57% of central bank reserves. That 57% shows you that Wall Street's efforts to make the dollar the standard of transactions after 1971 was effective. It's 88% of financial market trades, okay? But it's basically 100% of stablecoin denomination. So by moving to a synthetic dollar tokenized on a blockchain, the dollar could become even more dominant. And collectively, stablecoins are the 12th largest holder of treasuries in the world. By the way, that's at about 280 billion of stablecoin outstanding. Treasury Secretary Bessent thinks it could be a $4 trillion market, but once stablecoins own more than 1 trillion of treasuries, they will become the single largest holder of treasuries in the world. It's not that far away. And equally important, when companies build on the blockchain, they do essentially re-architect their business. They're able to actually become more efficient. And I think there's a lot of reasons for this. And by the way, as a side note, many of you wonder, how does AI fit into this idea of building on the blockchain? A16Z had a nice white paper. There's 11 sort of use cases for what you want to build on the blockchain around AI. I'm just going to highlight a few things, like number 3, forward compatible proof of personhood. That's like a project like WorldCoin. Number 6, keeping AI vibe coding apps in sync. I think an example of this is a device I'm wearing, which is uCritter, and this is measuring the CO2 wherever you are. The ideal number is 420, and it's currently at 980. So there's a lot of rebreathing of air in this room. And they actually say you shouldn't make any important decisions when the CO2 is above 600.
Wall Street, in conjunction with AI, is now actively building on the blockchain, laying the groundwork for what Lee describes as a new synthetic era. The U.S. regulatory environment, spearheaded by initiatives like the Lummis-Gillibrand Act, and the SEC's Project Crypto, alongside proposed legislation such as the Clarity Act and the Bitcoin Strategic Reserve Bill, is facilitating this monumental transition. This convergence will inevitably lead to an explosion in tokenized assets, extending beyond stablecoins to encompass equities, credit, real estate, and even intellectual property. Lee emphasizes that while Bitcoin retains its status as the OG digital store of value, the true disruptive force will be Wall Street's embrace of digital assets. He envisions Bitcoin potentially matching or even exceeding gold's market value, pushing its price to an astonishing $1.4 to $2.2 million. The underlying narrative, however, is the innovation Wall Street will unleash on the blockchain over the next 10 to 15 years, moving us toward a future where everything measurable and even invisible data becomes monetized on-chain.
And we get asked all the time, what is the benefit of Wall Street building on the blockchain? They'll say that banks work fine. I don't see how JP Morgan can become more profitable. Well, actually, companies that are natively built on the blockchain are inherently more profitable. For instance, Tether is raising capital at a $500 billion valuation. Look at the list of the 12 largest banks in the world. Tether is the second largest. I mean, think about that. Tether is 50% bigger than Bank of America, and Bank of America is a giant. It's twice the size of Citigroup, twice the size of Morgan Stanley. It's even bigger than Goldman Sachs. Okay. But here's what's interesting. If you look at the number of employees at Tether, okay, JP Morgan is an $869 billion market cap company with 317,000 employees. That's a market value of $2.8 million per employee. Tether has 150 employees. That's less than JP Morgan's analyst class, you know? It's probably like the June analyst class. And so that means Tether has a market value of $3.3 billion per employee. I think that's what you have to realize. Tether, which is a native blockchain company using public chains, has a value nearly the size of JP Morgan and with only 150 employees. So as Exhibit A, in my opinion, clearly building companies and rebuilding Wall Street on the blockchain is very profitable.
The immediate catalyst for this new synthetic age is the stablecoin boom, akin to the dollar's post-1971 reinvention. Stablecoins, essentially tokenized dollars, are strategically vital for the US, mirroring its historic efforts to ensure dollar supremacy. Currently, stablecoins collectively represent the 12th largest holder of US Treasuries, a figure projected to swell dramatically, potentially making them the single largest holder. This signifies a profound re-architecting of global finance, enhancing the dollar's dominance in the digital realm. Lee further illustrates the inherent profitability and efficiency of blockchain-native companies by comparing Tether to traditional financial institutions. Despite its relatively minuscule employee count, Tether's valuation rivals that of major banks like JP Morgan, boasting a market value per employee that dwarfs its legacy counterparts. This stark contrast serves as compelling evidence that building and rebuilding Wall Street on the blockchain is not merely an evolutionary step, but a revolutionary leap towards unparalleled profitability and operational efficiency.